Right. So today, as we were discussing, we'll try to cover two more financial statements. One is called changes in equity, and the other one is called statement of comprehensive income. So first, we'll cover comprehensive income, and then we'll get to equity, because equity has something to it requires understanding of comprehensive income. So we'll cover this first. So first of all, before I get into comprehensive income, so a quick recap. So previously we have covered income statement, balance sheet, and a cash flow statement, right? So this is a quick snapshot of the balance sheet for the company that we are looking at, ExxonMobil. We have assets, liabilities, and there is a term called equity, right? So we'll cover something that one of the statements that we are about to look at, changes in equity. It talks about this particular element. We'll talk about that in detail when we get there. And then in P&L statement or income statement, we have seen different income sources and expenses, etc., etc. And the final net income, what is the profit or loss that particular company has made in each year, right? And we can see in 2020, it has made a loss of 22 billion. We have also covered the cash flow statement. Here we have seen basically how the cash is moving in and out from various activities, and we have also seen like different types of cash flow accounting procedures, right? Accrual basis and cash basis, and we have understood what these elements are, and etc., etc. All of these things we have seen. So today we'll be looking at starting with comprehensive income. So this particular comprehensive income will have the information of what the net income that we have seen in the P&L or income statement. But in addition to that net income, it will also have any other so-called unrealized gains or losses. Okay, so this is basically something that the company may not have known at the beginning or the beginning of the period. Let's say if you're a company that is selling a particular product, like shoes, right? You can predict like what could be the cost or what could be the sales value that you will get by selling so and so amount of product. But there are certain elements that are normally unrealized, and you'll only be able to see them once they have happened, and those gains are called, we'll look at examples, and those gains are called unrealized gains basically. So in the income statement, these unrealized gains are not reported, and typically that is where comprehensive income will come into picture, and it will take the net income that was provided in the net income statement, and also add any other unrealized gains that the company has in that particular period, and show them all put together in one single place. So that is the idea of the statement of comprehensive income. So for example, if you would see, these are some of the examples that they have for this particular company, or these are just general examples, but it can vary from company to company. So here we can see the first item is net income from income statement, which we are all familiar with, and then we have some other gain or loss that company has accrued from any other these instruments or foreign currency and retirement. So let me give you example for foreign currency. Let's say if there is a US based company that is storing its let's say there is a branch in India, right? And they have saved some cash of about 1 crore rupees in Indian currency, and let's say Indian currency has against US dollar, let's say it's depreciated 5%, right? That means that 1 crore, if they have to convert back to US dollars, they would have depreciated almost 5 lakh rupees. So that is something unrealized loss, right, for them with the help because of the currency fluctuations, currency rate fluctuations. And so on the other hand, they can also see an appreciation instead of depreciation, and the 1 crore can also go up. So that will, in that case, that will be considered as unrealized gain. And likewise, if they have invested in certain stocks of other companies, right, in that case, if the stock appreciates, in that case, their value goes up as well. In that case, whatever the gain that they have made there, it will be again considered as unrealized gain. If they have made a loss, then it's also considered as unrealized loss. So there are several, these are just few examples, but there can be many other ways that the company can incur these unrealized gains or losses, and the statement of comprehensive income is supposed to capture all those things. So, and this is typically not considered popular, as we were discussing at the beginning, but for certain times it will be very important to look at as well, because if you look at this particular case, ExxonMobil, it has unrealized gains of about $2 billion. So for many companies it may be negligible amount, but if you look at this particular company, it has $2 billion of unrealized income. That means this $2 billion will go unaccounted in the income statement if you look at the income statement alone. So this is almost like their 10% or roughly 10% of their net income, right? So yeah, so if you look at this particular example here, so this is the simple example of comprehensive income statement, and on the very top we can see the net income on each of these years for that particular company, and then we see each individual elements and what is the loss or gain that we have made from each of those elements. And if you would we can see here amortization and settlement. So this is basically maybe this could be related to same depreciation sort of a thing, but amortization is similar to depreciation, but it is more of a different, it works more on a non-tangible assets rather than tangible assets. So, and some other, then we have foreign exchange. They have lost about $2 million here, and then they have translation adjustment. I'm not exactly sure what it is, but yeah, so they have a loss of $872 million, and then majority is coming from post-retirement benefits reserves adjustment. So this is, they have gained something about $3 billion here, and all of which that accounted to $3.1 billion. So we can see a couple of more elements. So they have split that into controlling assets and basically the same realized income or loss. They have split that into two sections, one at overall level, and I think this one is non-controlling. We'll see what non-controlling interests are when we go to equity statement, but for the time being, yeah, this is basically all the gains or losses which are not covered in income statement, but now in the incomprehensive income they are added to the net income, and then we can see the comprehensive income actual net to net has increased by over $2.4 billion.
So yeah, I would like to add one thing.
Yes,
it's basically any unrealized gain or loss is a theoretical profit or loss that just exists on paper, that has not been converted to cash, or any action hasn't been made. It's still on paper. Okay, so that line that you just said, that foreign exchange translation adjustment, and the next line, adjustment for foreign exchange translation included in net income, all that, right? So those two lines, they basically okay, let us say the company holds US dollars, okay, but the income statement is in Indian rupees, okay, that is what, so the headquarters is in India and they report in Indian rupees, okay, but they sell their products or services to US, and the clients pay in US dollars, okay. Now that US dollars is something that they have paid, let us say 1 month ago, and that USD has still not been converted to INR, okay, and in between, let us say the price of USD has become stronger against INR, right? That means then we will get more Indian rupees when we convert it, right? So that is a gain, but it is still not realized because we have still not converted it. When we convert it, whatever is the translation, then accordingly we will get the realized gain or loss. As of this moment, it is unrealized, and hence it should not affect the tax that we pay. Hence, it is not put in income statement, but it is put after the income statement, which is, in the comprehensive income. So we'll only pay tax for the realized transactions. So whatever it is, gain or loss, only when it is realized, we will add that to income statement and then compute tax accordingly on the income statement and calculate net income after tax. So the last but one line in income statement is tax, and the last line is income after tax, PAT, profit after tax, right? So or net income, right? So then anything that should not impact tax should come after PAT or net income, and that is the statement.
Yes, thanks enough. So yeah, typically all these elements also so tax is one of the major factors that Sinas talked about. So that is also one of the reasons why they put all these calculations separately. You will not, most of the times you may not see a separate statement as together called as comprehensive statement as we are calling it right now, but typically in the same income statement you'll also sometimes see these elements put together in the footnotes or something like that after net income, as Sina was mentioning. Thanks, Sina. Good point. So yeah, so that is on the comprehensive income statement. Now let's move to the changes in equity. Okay, so equity we all understand. So basically the amount of company has some shares that it will allow shareholders or other people to purchase and have some ownership, right? So what is the total shareholders equity that company has, and this particular statement is supposed to track how that particular equity is changing with time for that particular company. So this is linked to our balance sheet statement as we were discussing earlier. So this particular equity component in balance sheet and the this particular statement are very closely linked. There is a simple calculation that it follows typically to capture the changes in shareholder equity. So we'll talk about why changes occurs and all of these things, and we'll go into detail, but let's try to understand how they normally capture the change. So first, so this particular balance sheet we can see here at the end of December 2021, we can see that total equity is about $175 billion. So they will take that particular amount, which is what they call as beginning equity for the next year. So that means for 2022 beginning, that particular 175 billion will be beginning equity. And after that, for the next year, which is 2022, what is the net income that they have gained for that particular year, right? They will add that. And if they have paid any dividends to any shareholders, they will remove that, and the comprehensive income that which we are seeing just now, they will also try to, if you have gains from there, they will add it. If you have losses from there, they will subtract it. So this is basically one way to basically calculate the changes in shareholder equity. But again, this is not absolute rule. Like companies may tend to add more elements to the formula as well. So yeah. So then let's understand. Let's take a look at this particular example of changes in equity statement and try to understand what's happening in there. What information do we have there? So if you look at this particular statement of equity, there are few elements on the columns. We'll get to there, but on the left hand side we can quickly observe so that they're starting with the balance at the end of December 2018. That means this will be the beginning balance for 2019, and all this amount is something that they have gathered in the 2019. So we can see from the amortization of stocks that they have gained something called as 697. So these are divided again, all these categories, into multiple sections. We'll come there in a minute. And then there is something called as others where they have lost 300 million. And if you look at net income, which is categorized in the earnings reinvested, we'll talk about what this is in a minute. The net income element is going into the earnings reinvested, and the dividends that they have paid to the common shareholders, about $14 billion, they have removed it here. And the other comprehensive income, whatever that they have seen, either gain or loss, that they are adding up here as a $71 million. And acquisitions or sellings of any anything from the company, they have resulted in this much amount. And we can see from these are the different sections where we can see some elements and numbers. Now let's try to understand the components on the top. So starting with a comprehensive income, we have just seen understood what comprehensive income is, and then we have something called as earnings reinvested. Earnings reinvested is you can say in one way it's a cumulative accumulated net income for the company across all the years, right? So if you look at this particular element alone, that means up until December 31st, 2018, so it has accumulated of about $421 billion of net income in its entire company's operation up until then. So we can see here in 2019 also they have gained a net income of $14.3 billion, and of which they have paid about $14.6 billion, which is to the dividends. And of that, so there is a negative realization there, and that is removed from this particular accumulated earnings reinvested, and that becomes the earnings reinvested for the next year beginning, right? So this is how net income and dividends play in accumulation of the earnings reinvested. So, and then the other element, comprehensive income, we have just seen, and there is something called as common stock held in Treasury. So this is also known as Treasury stock, which basically means that, let's say when a company goes IPO, it provides some certain amount of company's ownership in from, so they create shares and sell it on the stock market, right? So after a certain time, company may purchase to limit its amount of shares that are available for public to trade on the stock market, and it can try to repurchase some of those shares back with to the company. And whatever the shares that the company repurchases back from the market, they are called treasury stock. So we can see here that as of 2018 end, they have purchased about $225 billion of stake back into the company from the market, and in this particular year, so it will always be negative component, and because that is something, the cash that is going outside from the company into the market to the shareholders, right? So it will always be negative. And second thing is these dividends, now that a company holds this much amount of stock with itself because it has repurchased itself, obvious question comes is, like, typically if someone holds shares, they would expect some dividends or etc., right? So, and these dividends are paid, but treasury stocks are slightly different than the normal stock that people try to hold, common stock or preferred stock. So these treasury stock will not get any so once the company purchases back and it's converted to treasury stock, it will not have any dividends associated with it. That means it cannot gain any dividends with it, or at the same time it will not also have any voting power to make any decisions in the companies, how the company should grow and all. So these amount of shares will not have any such voting power as well in terms of decision making. So why company normally does that? So one of the reasons that that I am aware of is basically they basically try to limit the amount of stock that is available in the market. This can happen for multiple reasons. Maybe they again, so they could be seeing that not having a much stock to trade in the market is beneficial for them. If they see that, then they might purchase, or if they see that the stock value, for many other reasons that can happen, but typically this is the one of the reasons that I know. They try to limit basically the amount of stock that the market has to trade in the between themselves, so that they try to repurchase back. So that is the aspect called stock treasury. And then there is something called as common stock. This is something, if I'm not wrong, that is available for all the other shareholders to purchase and trade amongst themselves. So that is about like $15 billion, just less than much less than the stock that is held in treasury. And this particular element is the summation of all these elements put together. So we can see here earnings reinvested all and the treasury stock, common stock, all of them combined together, it adds up to $191 billion. And once we there is another element called non-controlling assets, so non-controlling interests. So this is basically controlling and non-controlling is defined by the amount of ownership that particular entity which holds those shares holds. Let's say if I'm typically, as the rule is, if someone is holding less than 50% of the entire shares, then that means they are not a majority. If someone is holding above 50%, that they can essentially control all the decisions that can be made in the company, because they have majority voting power and all. So because of those things, those entities who holds 50% or more shares is considered as controlling interests. And these are on the other hand people who hold technically less than 50%, but in reality it can be much less than 50%, maybe just fractions of ownership in the company. So what are the numbers of all these things in that group as well? So they look at basically two main categories: ExxonMobil's share of equity and then non-controlling equity, and they both combine it together to get the total equity. And this particular total equity at the end, it should match with the number that we have seen in the balance sheet statement. Let me see if I have anything to add. Yeah, so I think that's pretty much it. Different companies may have different elements here. Here we are only seeing common stock, but there are some cases where you will see different types of stocks again. Something called as preferred stock is also there. But in this particular example, we are not able to see. But yeah, different companies may have different elements based on how their equity is split up. They can see those categories here, and but eventually the total equity should be able to match up. And this is how these particular main elements are: earnings reinvested, which is a cumulative net income, kind of a cumulative net income, and then stocks in treasury. These sort of things will help you understand some more things on the top of the usual financial statements like income statement and balance sheet. Yeah, if you have any questions, I'll be happy to answer.
I'll just add one thing related to that. Non-controlling interest. It's basically minority interest. It's also called as minority interest. It is so basically it is not common stock, and it is not the major stockholder. It is anything in between, and typically any other companies that hold a good chunk of our stocks but less than 50%, say 20 to 30%, they come under this group called minority interest. But they are not a common shareholder like you and me, and they are also not the major shareholder who has the decisions and voting rights. So this is a company or a shareholder who has a significant chunk of our shares but doesn't have the right to control the decisions in our company. So they are called as minority interest, and they want to look at them because at any point in time, if all these takeovers and stuff like that can still happen, like from those companies. And they also want to give at least some decent amount of thought while taking major decisions by just trying to understand what those companies would think, how they would react, because they are still a significant shareholder. So that's why they keep that separately. Yeah.
Okay, that's interesting. Okay, so they do hold a significant amount. Okay, I thought it otherwise. Okay.
Yeah, it'll be typically 20 to 30 in that range.
Okay. Thanks, Anna.